Hello everyone. We will wait until few more people can join and then we'll start the webinar. Thank you. Hello everyone. Good afternoon and welcome to you all to today's webinar. Thank you so much for joining us today. I am Saleha and I will be your moderator for today's webinar, and our today's session is titled IFRS S1 and S2 ESG reporting readiness for GCC listed companies. So let me start by introducing uh, let me start by introducing the organizers of today's webinar. The Institute of Financial Accountants, also known as IFA, established in 1916. IFA is an internationally recognized professional accountancy, a membership body providing dedicated support to SMEs and SMPs. IFA is also a part of Institute of Public Accountants. We are a full member of the International Federation of Accountants, the global accounting standard setter and regulator for the accountancy profession. As such, the IFA takes its place alongside the UK and Iceland six chartered accountancy bodies as well. So now it's my pleasure to introduce our two expert speakers for today. Our first speaker is Ashley, and she's an ESG manager at Innova. Ms. Ashley, kindly introduce yourself to the audience. Thank you.
Thank you very much. Hello, everyone. Good morning or good afternoon. Yes, my name is Aslı, and I am joining from Innova Beyond Digital. I am coming from a legal background. I'm a lawyer and also an ESG manager. So my work day to day includes accompanying companies from different sectors throughout their sustainability journeys, including creating sustainability strategies, creating action plans, running workshops and training sessions, and helping them to produce a sustainability report at the end of their journey and move on with the sustainability related steps. Thank you very much, and excited to be here today.
Thank you so much. And our second speaker is Manhal Makbul. And he's senior manager in advisory at ATH Guideline. So please introduce yourself.
Thank you, Sonia. So my name is Manhal. By qualification, I'm a CFA charter and a fellow ACCA member. For almost a decade now, I've been in the ESG space, helping companies in developing their international frameworks, adopting international frameworks, developing ESG strategies, and pioneering their ESG reports. At ATH Guideline, we help organizations across GCC in executing these projects across the board.
Thank you so much, sir. So now we would like to have a poll session with you guys. I will share the question in the poll. You can answer them by choosing the right option. So, and meanwhile, I will read the question in my screen. So I'm launching the question. I have launched a question number 1. I would really appreciate if everyone could answer it. Thank you. Okay, so our question number 1 is, does your organization currently produce an ESG or sustainability report? Option A is yes, we publish one annually. Option B is partially we have started, but it's not yet formalized or assured. And option C is no, we don't produce one today. Please do answer, everyone. Don't skip this one. Thank you so very much. The more of you that answer, the more valuable this becomes for everyone. So I'm waiting for your responses. Okay, I'm ending the poll for the question number 1, and now I'm launching the question number 2. Please do answer the question number 2 as well. Okay, I have launched the question number 2 in the poll. Kindly do answer the question as well. So here is the question number 2. How ready do you feel for IFRS S1 and S2 disclosure? Option A, well-prepared governance data and processes are largely in place. And option B, partially prepared. We have some pieces, but significant gaps remain. And option C, not started, we haven't begun preparing. I have already launched the question number 2. You can answer the question there. Thank you so very much. We would love to see a response from each and every one of you. Okay. Okay, now I am ending the poll of question number 2, and we will move forward to the last question, question number 3. Please do answer the question number 3. Okay, I have launched the question number 3. Please do answer it. And our question number 3 is, which area would you most value expert support in? Option A, materiality assessment and identifying relevant ESG topics, GHG emission accounting scope 1, 2, and especially scope 3. And option C, governance data systems and disclosure framework setup. We are waiting for your responses. Okay. I'm repeating the question number 3 and their options. I would really appreciate it if everyone could answer. Which area would you most value expert support in? Materiality assessment and identifying relevant ESG topics, GHG emissions, accounting scope 1, 2, and especially scope 3, governance data system and disclosure framework setup. The more of you that answer, the more valuable this becomes for everyone. So I really appreciate your participation. Okay, let me end the poll and let me share the results of each question. I think so. Someone is okay. Okay, let me share the results with you guys. Here is the results of question number 1, sir. Does your organization currently produce an ESG or sustainability report? Yes, we publish one annually. Option one has 14% response. Option B 65%, and the option one have 21% response.
Can we move on with the other questions?
Okay, sure.
And maybe we can, yeah. Mm-hmm.
Okay. Result of question number 2. Can you see the results?
As hosts, I believe we can see it,
Yeah,
but
we can see
I'm
them.
unsure. Yeah, I'm unsure about the participants.
So regarding question number 2, the question was, how ready do you feel the IFRS S1 and S2 disclosures? 4 out of 37 responses were related to well prepared. Governance or data and processes are largely in place. 41% of the companies are partially prepared, and out of 18 responses were they haven't been started. The process is yet to be started. Soleh, can you move to question number 3, please?
Yeah, sure, sir. Okay. Okay, here is the question number.
Question number 3 was, which areas would you most value expert support in? So about 39% or 14 of your responses were related to materiality assessment and identifying relevant ESG topics. Second number was governance data systems and disclosures framework setup, out of which 16 of those people requested they would need support on this area, and 17% or 6 people said that they need help in GHG accounting system, especially in scope 1, 2, and 3.
Okay. Leslie, you can control my screen now. Thank you.
Yes, perfect. Thank you very much.
Yeah,
So let's
welcome.
move on with the agenda of today. Thank you very much for your answers to our polls. Like it is very helpful for us to understand what kind of an audience we are talking to today. Before we dive into details, I want to quickly look at the roadmap for today's session. We will first heavily focus on the key strategic shifts reshaping the business that we're seeing today. We will kick off here with the introduction to the global reporting shifts, and we will look exactly who is impacted under scope and applicability of IFRS standards, IFRS S1 and S2. From there, we will connect everything to the corporate strategy. Here, I can say that we saw most of you answer to the third question, that you need expert support in materiality. We will discuss here the materiality framework and also the concept of materiality. Next, we will start tackling the requirements of greenhouse gas accounting and emission scope to demystify carbon tracking. We will ground all of this in the, let's say, regional realities by looking closely at GCC landscape, the regulatory landscape. Then we will wrap up with a practical look at readiness, priority areas, and data requirements. Doing so, we aim to leave you today with a clear, actionable roadmap and steps that you know that you need to take. With that being said, let's jump into our first topic right away. Okay, so let's talk about the global reporting shift, which is the first major topic we're going to discuss today. The core takeaway that I would like to give here is that we are seeing a rapid shift from voluntary disclosure to a unified global baseline. For years, we were seeing that ESG reporting was quite voluntary. Anyone could choose whichever standard, whichever guideline they want to follow. But now I can truly say that this era is over. There are some developments that are driving this change. First of all, the establishment of the ISSB, International Sustainability Standards Board. Since its creation, the board has really shifted this landscape. They released IFRS S1 and S2, and these standards, S1 and S2, has already seen adoption from a lot of jurisdictions. More than 68 jurisdictions are now mandating the use of S1 and S2 to different actors like some of them are mandating it for listed companies, some of them are looking at the sectors, and we're going to talk about it more detailed in the next slides. We know that regulators across the Middle East and GCC are also incorporating IFRS standards into their national legal frameworks. Why? In order to attract international capital and meet also state-level net zero targets more easily. Now we know that a lot of GCC countries have, let's say, like net zero 2030, net zero 2050, 2070 strategy. So in order to meet these targets more easily, they are like these countries, these jurisdictions are mandating IFRS S1 and S2, incorporating them with their national legislative landscape and pushing private sector companies to, let's say, meet the net zero targets. It's important. Why? Because like we see that, let me make one last note here before move on. It's important because now, let's say, it's still voluntary for many companies, but we see more and more jurisdictions, more and more authorities mandating these disclosure frameworks, standards, meaning that even if it is voluntary today, it could be mandatory for you immediately. This is the bottom line for everyone in this room. It is still voluntary today, but it is going to be mandatory soon. So what does it mean? It means that preparing today is going to make your work much easier tomorrow. Preparing your data architecture now is the only way to stay ahead of the curve when it becomes mandatory for you. Let's look at the scope and applicability, right? Here, I want to first talk about who these standards affect, especially who in our region. If you are a listed entity, let's say, on the ADX, Abu Dhabi Exchange, DFM, Dubai Financial Markets, Tadawul, or Bahrain Bourse, this is landing directly on your desk. The same goes for CBB regulated financial institutions and also any entity looking to access international capital markets. But what I want to say to everyone here, because I know that from the audience, you can directly say, okay, we're not listed, so it's fine for us. But like it is like there is the catch that most companies completely miss. The supply chain participants of these different, let's say, markets, or even supply chain participants of public investment funds, PIF of Saudi Arabia, ADIA, Abu Dhabi Investment Authority, and also other sovereign linked entities will face trickle-down mandates. So this means, in other words, even if you aren't publicly listed, and these standards don't apply to you directly, if you sell to region's giants, you will need to be ready to provide that kind of data. So now you ask, which data exactly? IFRS S1 and S2. We can now break everything down to these two standards and look at these two distinct but intertwined frameworks. First, starting with IFRS S1. This is going to be your broader umbrella. I always like to show it something that is more encompassing, because IFRS S1 requires the disclosure of all the sustainability related risks and opportunities that could reasonably affect your company's enterprise value, your company's cash flows, or access to capital. Second, IFRS S2. This builds directly on S1, but narrows the lens specifically to climate-related risks and opportunities. Here, I would like to stress that these two standards must be applied together. And here it's important to look at the pillars of disclosure. Regardless of whether you are reporting under S1 and S2, because maybe both of the standards are not mandatory for you yet, so you want to start with S1 or you want to start with S2. Regardless of whether you're reporting under which standard, your disclosures must be organized across 4 functional pillars. If some of you are familiar with TCFD, you are going to see that these pillars are quite similar: governance, strategy, risk management, metrics, and targets. When we are looking at the governance pillar, you really have to show how your board and management actively monitor the sustainability risk. Strategy part is quite integrated in the standards, and here we're talking about how different realities, climate or sustainability related realities, risks and opportunities affect your actual business model. And here we're looking at 3 to 5 year financial planning. This needs to be shown in the reports. Then we have the risk management pillar. What are the exact operational processes you use in order to identify, in order to assess, and also prioritize these realities, these issues? Fourth one is related to metrics and targets. And here, this is where we are talking about hard data. Also, we have seen that some of you, again, to the poll answers, most of you said the metrics and targets are the other pillar that you would require some expert guidance, expert support in. It's important to show that you are collecting, you know which metrics and targets you're focusing on in order to show how you're performing against your goals, how you're managing your risk. This is the disclosure part. So to understand, we have this 4 pillars of disclosures, but to understand how S1 and S2 differ in practice, we can look at different industry examples. For example, under S1, we can say that a food and beverage company may look beyond just climate and to focus more on broader environmental risks like water scarcity in supply chains, impacting financial statements via necessary capital expenditures. Of course, for every sector, for every company, the disclosures, the focus will look different, right? And under S2, for example, again, different sectors will have different focus. We can give an example of a real estate firm. If they evaluate physical versus transition risks, like for physical, like an asset's exposure to worsening flood zones, and for example, for transition risks, we can talk about the looming retrofitting costs required to meet new green building regulations are going to fall under the scope of, under their focus, under their radar, basically. And what is important here is how we tie everything together. It requires us to really focus on scope 1, 2, and 3 mandate. And this is something we are going to discuss more further ahead in this presentation. Under IFRS S2 especially, reporting your greenhouse gas emissions, I'm talking about absolute gross greenhouse gas emissions, is no longer a voluntary requirement. It is becoming completely mandatory, and we see it from S2, IFRS S2. I would like to look at how we can really link everything together and have a relationship to the existing framework. This is a common question, let's say, coming from our clients. We have spent years aligning with other ESG frameworks. So does all that work go out of window now? The short answer we give to them is absolutely not, because we can think IFRS framework as a consolidation rather than a brand new set of requirements. For example, SASB, we have this matrix here, but I'm going to turn it upside down a little bit and start with SASB. SASB has an industry focus, right? It has, on top of my head, 77 industries are covered, and its industry-specific metrics are already completely embedded right into S1 and S2. The same goes for TCFD. We have just seen it. TCFD recommendations have been fully incorporated into S2, which is why also we have these 4 core pillars we have just discussed look so familiar. When we talk about CDP, CDP disclosure platform is also actively aligning its questionnaires to match IFRS data points. Why? Because IFRS is becoming obligatory for a lot of companies that are also using CDP. So it makes sense that the questionnaires really match the IFRS data points together. GRI and Europe's Corporate Sustainability Reporting Directive, there's also a relationship that is highly complementary with IFRS, while GRI and CSRD focus heavily on double materiality, which is something we're going to talk about in a bit. ISSB remains really focused on financial materiality. They talk to each other, but they serve distinct purposes. Moving on, I want to break down IFRS S1 and S2 into core principles. First, IFRS S1. It functions on 3 guiding principles designed to make your corporate sustainability data actually useful to the market. It requires materiality, meaning you only focus on what truly shifts financial value. It demands also global consistency, so an investor can compare your data against any corporate, corporate worldwide, company worldwide. And finally, it also relies on the connected information, the connectedness, in order to make sure that whatever sustainability story you are telling directly will match up with the numbers in your traditional financial statements. Then, when you shift your focus into S2, we're again talking about the guiding principles. We have, first of all, it looks at physical risks, like how extreme weather patterns today directly threaten your business, threaten your offices, factories, supply chains, and so on. We also have transition risks that it captures, which are sudden regulatory or like market shocks, market shifts that your business would face as the world moves toward a low carbon economy. Then we have the climate-related opportunities, which gives you the structured way to report on how your business is positioned to capture the new opportunities, new markets, driving efficiently like how the growth, how the opportunities would look as the entire landscape shifts. We talked about the materiality part in the first part of the core principles of S1. I want to talk about materiality more because this is basically our bread and butter, let's say. It is really important to make sure the materiality principles are applied correctly. Let's talk about materiality and what it actually means under IFRS lens. First, when we talk about IFRS, we are talking about financial materiality. Financial materiality refers to factors that have a direct impact on a company's financial performance. So it's about identifying which issues, such as regulatory risks, climate-related costs, or supply chain disruptions, could really influence key financial metrics like cash flow, like profitability, or access to capital. In other words, that you see here, if something influences, something has the potentiality to influence or affect investor decision-making, then it is considered financially material. To get to that point, you have to execute some steps of the assessment process. First, you need to map out and identify the sustainability topics relevant to your sector and your geography. Then you need to evaluate how these topics quantitatively impact your financial position, financial performance, and cash flows. Then you need to look down the road and determine the significance of these impacts across short, medium, and long-term time horizons. Then you need to set your formal disclosure scope based on those findings. But of course, we said that this is when we are looking at IFRS, we are talking about financial materiality. When we are talking about GRI or other standards, we may be talking about double materiality. I'm only going to spend a couple of minutes in double materiality and then leave the word to Minhal for the rest. But it's important to see double materiality concept becoming a business reality. What is it? First of all, I would like to clarify the meaning. It is double materiality. It is a materiality approach that is basically built on two distinct dimensions. On one hand, we had impact materiality, what we have seen many years on GRI, and financial materiality. Impact materiality looks at the effects of the business on the environment and on people. So we are talking about a inside-out approach, like my impact on the environment and people. This is inside-out perspective, and it asks questions like, how do our operations, products, and supply chain affect climate change, affect workers' health and safety, or local communities? Financial materiality, what we have under IFRS, looks at risks and opportunities for the business. And this is the outside-in perspective. As we said before, it focuses on how sustainability issues can affect your financial performance and business value, which is something also investors place high attention on, right? Sorry, I didn't want to move too fast. Here, we know that double materiality was a concept with EU Corporate Sustainability Reporting Directive first. But now, even if double materiality is not mandated by the reporting standard you are following maybe, but it is advantageous for assessing and managing ESG impacts, risks, and opportunities. That is the reason why for all our clients, we are following double materiality, even if it is not a mandate, because it makes sense. So you don't do double work. You're integrating the sustainability-related topics directly into your enterprise risk management. And this is how you can actively perform double materiality assessment, which is quite similar to what we have seen for the 4 steps that we need to follow to perform financial materiality assessment under IFRS, right? First, we need to identify potentially material topics, looking at the sector, looking at the what is important for the company, looking at the laws and regulations. Then from there, we're going to break it down into 2, and we're going to look at the impact materiality and financial materiality. We will engage with stakeholders here. We're going to analyze the results, and we will define the financial and impact related material topics. We can have a matrix, we can have different ways of visualization of our material topics. But what is important here that we have the results that are allowing us to prioritize what is important for us from the impact perspective and what is important from the financial perspective. From there on, we are going to take these results and we're going to put this at the heart of our disclosure under the chosen reporting standard that we're following. So this is how we can really perform double materiality. From here, I am leaving the word to Minhal, which is going to move on with the greenhouse gas accounting and the GCC focus.
Thank you, Ashley. Thank you very much. So, everyone, greenhouse gas emissions is something that most companies feel pressure about. Greenhouse protocol is global standards and it defines into 3 stages. Number 1 is scope 1, number 2 is scope 3, and number 3 is scope 3. So Scope 1 covers direct emissions from sources the company owns, controls, company vehicles, on-site fuel combustion, refrigerant leaks, process emissions. Scope 1 is usually the most accessible because the underlying data, fuel bills, and equipment records already exist within the organization. Scope 2 covers indirect emissions from purchased energy, primarily electricity, but also steam, heating, and cooling. There are two type of reporting methods: location-based, which uses grid averages, and market-based, which reflects specific contracts and power purchase agreements. Scope 2 is particularly significant in the GCC, where grid electricity is largely used in hydrocarbon powered. Scope 3 covers all other indirect emissions across the value chain. This is where the most emissions actually sit, often 70 to 90% of the total footprint. The GHG protocols defines 15 scopes in three categories, and this is the most complex and intense data area of emission accounting. We recently were working with one of the hospitality industry company based out of South GCC. The most challenging for us was scope 3, because scope 1 and 2 were easily calculated using their electricity bills and their fuel consumptions. But when it came to scope 3, we actually had to work with the organization and their stakeholders for almost double the time that we spent on just on scope 1 and scope 2. So for scope 3, categories matters most of for the GCC is category 1, where purchase goods and services apply to virtually every sector. These are the emissions embedded within in what company buys, for example, raw material, equipment, services. Then there's category 11, use of any sole products. This is critically for energy and industrials. For example, for an oil and gas company, category 11 can represent about 80% of more total of their total emissions. Then there's category 15, financed emissions. For example, this finance emission usually applies to banks, insurers, asset management companies, and the Partnership for Carbon Accounting and Financial provides the leading methodology in this space. Then there's category 3, which focuses again on fuel and energy related activities. For example, capturing upstream emissions from fuel production and electricity transmission losses. It is particularly important for energy and utility sectors. Uh, the practical message on the greenhouse gas accounting is simple. Start with scope 1 and scope 2, which are achievable in year 1. That is how we usually recommend to our clients as well. Build scope 3 progressively and start with the categories most material to your sector. Moving on, the ESG reporting landscape. So the reporting landscape is divided into four types of disclosures. First is regulatory and investor facing. Second is stakeholder reporting, voluntary platform. And fourth is integrated reporting. So, regulatory and investor-facing disclosures are mandatory submissions to securities regulator and stock exchanges. ISSB aligned reports sit firmly in this category. The audience is investors, regulators, and analysts. Stakeholder reporting usually addresses a broader audience: employees, communities, NGOs, our customers. These reports are typically aligned with GRI, with the focus on with the focus on impact, community engagement, and social performance. Whereas voluntary and platform disclosures include CDP, S&P Global, CSA, MSCI questionnaires, and any third-party assessments. These are the investors base submitted to the platform, and they feed directly into the ESG ratings and index inclusion. We were just working with a company based out of Saudi Arabia, which is one of the biggest real estate companies of Saudi Arabia, where we help them out in improving their MSCI questionnaires, in improving their MSCI ratings. So again, it is not mandatory in Saudi Arabia to report ESG. However, the company wanted to improve their ESG ratings in terms of MSCI, from which their investors look their ESG reports and make investments in the organization. Lastly is integrated reporting, combines financial and non-financial reporting in a single document. It tells the story of value creation across financial, manufactured, human, intellectual, social, and natural capital. The strategic insight for most large GCC companies is this: you will likely produce some combination of all four. Your internal data systems therefore need to serve multiple outputs from a single source. Building separate workflow for each report creates reconciliation problems, driving up cost, and introduces assurance risk as well. Moving on to the GCC regulatory landscape. Each GCC regulatory has moved forward with its own ESG regulatory architecture. And although there is convergence, the specifics differ. For example, in UAE, federal decree law, which came in 2024, establishes that climate change related obligations and underpins the UAE's commitment to net zero by 2050. ADX, Abu Dhabi Exchange, and Dubai Financial Markets both have ESG disclosure guidelines aligned with the ISSB principles. Currently operating on a comply or explain basis, but trending towards mandatory adoptions. ADGM, Abu Dhabi Gold Market, and DFSA have introduced sustainable finance frameworks within their respective free zones. And the COP28 legacy is significant. The UAE hosted in late 23, and the resulting global stock take has driven policy momentum across the region. In Saudi Arabia, Tadawul has issued ESG disclosures aligned with ISSB. SAMA, the Saudi Central Bank, is integrating ESG consideration into banking. Banking, PIF, the Public Investment Funds, is driving ESG requirements across its portfolio companies, which touches a substantial portion of the Saudi economy. Related to the PIF, we just worked with the company, one of the PIF entities, where we have been notified that all the companies in the PIF entity have been asked to create an ESG policy and have asked to create themselves net zero by 2050. So a strategic move into these companies is imminent, and all of these companies are expected to make strategic investments in a way that their goals of net zero by 2060 can be achieved by 2060. Whereas in Bahrain, CBP made it mandatory. Sorry. Bahrain boards has issued ESG reporting guidelines for listed companies. More significantly, the CBP requirement module was issued in November 2023. This is one of the most concrete regulatory mandate in the region. It applies to CBP regulated entities, including banks, insurers, and investment firms, and it sets specific timelines and disclosure expectations. We have helped a lot of CBP regulated entities within the organization, within the region, in which we help them out in applying this CBP regulated framework, helping them in creating their ESG report along with long-term strategies as well. So the cross-cutting observation is this: the GCC is moving in parallel, not waiting for global mandates to cascade down. The trajectory is unambiguous, from complied or explained towards mandatory, and from voluntary towards assured. Companies operating multiple GCC jurisdictions need to map their obligations carefully. Convergence helps, but every regulator has its own nuances. Moving on. Materiality in a GCC context. So what is actual material? Material varies dramatically by sector. Let us work through this with the regional context in mind. For example, financial services, finance emissions are the central issue. The carbon footprint of loan books and investment portfolios, climate credit risk, which is how borrowers exposed to climate risk affects. Sorry. to climate risk affects loan performance is increasingly material. And ESG integration is lending decision is now expected practice. For real estate, physical climate risk is acute in coastal GCC regions with sea level rises, extreme heat, flash flooding, all relevant. Energy efficiency is significant because cooling can represent 60% to 70% of building energy use. Green building certifications like LEED, Estimeda, Postema are increasingly standard. Water consumption is landscaping and operational is also material. For energy and utility companies, Scope 1 and Scope 2 intensity is now mandatory disclosures under S2. Stranded assets risk is the dominant strategic concern for transition planning. How the business model is evolving is where the strategic conversation now sits. For insurance, climate risk underwriting is material as claim frequency and severity grows. Catastrophic modeling has become significantly important for property and infrastructure risk. For tourism, water and waste in the resorts and operations are core material topics. Labor rights and particular relevant in the region given the use of migrant of workforce, biodiversity protection in coastal and sorry, desert development is an emerging concern as development continues. For industrial, I'll ask my co-host to explain on those areas.
Yes, sure.
Ashley, over to you.
Yes, I will go very quick and brief, being mindful of the time. So can we go back to the the slide? So when we are talking about industrial or manufacturing plants, we know that they care heavily about supply chain emissions and also direct financial impacts of carbon pricing on their exports. That's the reason why we need to see the previous slide if we're still talking about materiality.
Yeah, sorry.
Yes, please. Yes, perfect. When we are talking about tech, health, and retail, the priorities are also distinct, also for consumer goods. That we know, for example, for telecommunications, we know the telecommunication firms are managing really massive energy consumption of their data centers alongside the cybersecurity. When we're talking about healthcare, we know that they look at biomedical waste management and, for example, patient privacy is another material topic. When we look at retail, we know that the sustainable packaging is important, circularity, critical regional dependencies like food security. But what I want to say here for the sector-specific material topics, there is a great platform, open source from SASB, SASB Materiality Index that looks at all the sectors and gives you directly what are the topics that are potentially material for your own sector. So this is something you can use and supported by your expert advice. We can move on. Thank you. Back to you, Minha.
So the closing point on this slide is critical. Materiality is not static. It must be reviewed annually, and regulatory landscape, climate science, and stakeholder expectations evolve. What is material in 2026 may not have been material in 2023. Moving on to the last topic of the day, readiness, priority areas, and data requirements. So ESG readiness is fundamentally a cross-functional challenge. The data sits across finance, operations, procurement, legal, and HR. It cannot be owned by a sustainability department sitting alone. Cross-functional ownership is a prerequisite for readiness, not an outcome of it. The CFO and the audit committee must have to be active sponsors for the readiness program. The first priority area is governance formalization. The required data includes board mandate document, the writing of the charter for sustainability oversight committee minutes that evidence real oversight discussions, and a documented accountability structure with clearly assigned KPIs. Without this, the foundation, everything else is built on. The second priority area is materiality assessment. The required input are the sector's topic universe. You start long list, financial impact mapping, documenting methodology, and engagement evidence from stakeholders and internal process owners. Third is the GHG inventory for scope 1 and scope 2. The required data includes energy bills, electricity, district cooling, and gas, fuel logs for diesel and petrol, fleet records detailing vehicle type, mileage, and fuel efficiency, electric consumption broken out by facility for site level analysis, and refrigerant cooling, which are often overlooked but can be material as well. The fourth priority area is climate risk identification. The required data includes a complete asset register with localization data, geographic exposure analysis showing which assets are in climate exposed zones, and revenue sensitivity analysis examining how extreme weather events can be. The fifth is scenario analysis. The required input are detailed business models documentation, referencing scenarios from authoritative sources like IEA, NGFC, IPCC, and both quantitative and qualitative analysis under this climate futures, typically modeled at 1.5 degree to 2 degree and 3 degree plus warming scenarios. On sequencing, all five priorities cannot be tackled simultaneously. Governance and materiality comes first. Scope 1 and Scope 2 data should run in parallel because the systematic the data takes time. Scenario analysis, the most analytical demand piece, and often benefits from external expertise. A realistic first-time disclosure timeline runs from typically from 12 to 18 months from kickoff, even if mandated deadlines stretch further. This is a journey, not a single project. The companies that starts now will take time to mistake and learn from them. The companies that wait until mandate will face the same learning curve with no time to absorb it. Thank you, everyone. We'll now take questions. Please put your whatever questions that you guys have in the Q&A box, and we can answer them from there on. Soleha, can you confirm, please, if the question and answers are open?
Yeah, Q&A is open for all the participants.
Perfect. Mr. Ansar, you can put your question in the Q&A box and we can take it from there.
Yeah, Ansar Abbas is raising a hand, I think so. You want to ask?
Everyone, we would request you to kindly put your questions in the Q&A box so we can take your questions from there on, please. I think there was some technical glitch. I think you guys can ask the questions now. Yes, Mr. Ansar, you can put it in the chat and we can answer that question. Uh, Mr. Ashish, not sure which region are you referring to. If you're talking about Bahrain, yes, it is mandatory for a certain kind of category of companies. In UAE, as per federal decree law, all the companies has to report a certain set of information. You can refer to a federal decree law, which gives a detailed outline of it. Or we can set up a call with you to give you a more detailed answer related to that. So as per our expectations, because in COP28, the companies have made a significant commitment. Mr. Arsalan, I'm answering your question. So it is expected to be mandatory probably by the end of this year or probably next year. However, as per federal decree law, there is a certain set of information that is required to be reported for now. Ashley, would you like to answer Mr. Ansar's question related to S1 and S2 impact on sectors like banking? You're mute right now.
Yes, okay, of course. Thank you. And like here, like we see for the banking and let me read your question. Sectors like banking, insurance, and reinsurance, and also let us know about KSA region. Yes, first of all, like for the banking, we know that the financed emissions are quite important, the scope 3. Here, like under IFRS S1 and S2, we know that banks must track and disclose their greenhouse gas footprint of the like businesses they are lending to, right? Also, we should talk about the risk pricing. Lenders must stress stress test how climate change, like carbon taxes, like physical damage, are going to affect the loan defaults, let's say. And we also have for insurance and reinsurance parts that you're asking, we have the climate volatility. We know that insurers now must show the investors how severe the weather patterns affect their underwriting pricing and also claims models. Then we have the asset allocation aspect because they really hold massive premium reserves. Now we can say that insurers must de-risk their investment portfolios from carbon heavy assets. This is important. So when it comes to KSA, we know that in Saudi Arabia we have 2030. It is driven by the Saudi Central Bank and Tadawul. Now, like we know, Saudi Arabia is transitioning from voluntary ESG guidelines towards IFRS S1 and S2 adoption, which also catalyze more green financing. We see regulators heavily prioritize now disclosures for entities that are issuing that are green bonds or sustainable debt. We also, like an example from Takaful integration is that in KSA we have these standards that are being adopted to harmonize with Islamic insurance rules. So we see Takaful's implementation and also more possible implementations by other authorities, all for the Vision 2030 alignment for KSA, for the Kingdom of Saudi Arabia. I hope this clarifies.
Yeah. So next was how to collect. So Ashish, there's a detailed process that needs to be followed. An ESG committee needs to be formed, a certain set of responsibilities to be given to certain set of departmental people. The KPIs have to be aligned, as we discussed in the presentation as well. However, if you would like to have a detailed discussion related to that, we'll share our contact details. We can set up a call with you guys. KSA stock market has one main market and one parallel market. So whether these requirements would be applied all at once. So first at main market, my second question. So for now, Mohammed Bilal, I think if the regulation comes on, it will be from the regulator himself. So it will be coming to all the companies across the board, which are listed, banks and insurance, because that's the usual starting point. And we expect that it should be somewhere next year, early next year, in 2027. At least a framework would be there for companies to start reporting, because the first step would be to collect the information. And then once the information is collected, they can create a benchmark for each kind of sector. So the companies can be ranked and companies can be appreciated or penalized accordingly. And your second question was is relating to how to present value to CEOs that ESG reporting would bring more financing suppliers trust. Please share an example. So yes, I can show you an example. Even if we look at the European funds, they tend to make an investment based on, there's a regulation called PASI regulation, in which each fund manager requires to report a certain set of information on whichever the company that they are making an investment. So if you are a listed company, I think it would be very wise for you to disclose this information, so that an investor point of view, from the investor's point of view, you can get more exposures. Correct me if I'm wrong, Asli, if you would like to add anything to this point, because in terms of European investors, people are very much concerned when making an investment in GCC, in American markets, or North American markets, or in or any markets across the globe. They would very much would like to see what kind of investments they are making in, and what kind of companies, not just on profitable, but on the ESG perspective as well. Anything that you'd like to add on this point, Ashley?
No, that was quite clear. Yes.
Perfect. We will highly appreciate if the disclosure templates are made available to us to fully align, and we can follow to comply with IFRS S1 to disclose in the financial statements. So, Answer, these statements and the regulation itself, the standard itself is readily available on the internet. The disclosures that you are expecting, I think they are different for each sector, different for each company, because every company's business model is different. Every company's DNA is different. So these templates, I don't think they are standardized templates, but if you would like to have a detailed discussion on this, we can surely set up a call with you guys and have a discussion on this. Is there any framework to collect ESG data? There are multiple frameworks like GRI, TCFD, ISSB, and S1 and S2. The company can collect whichever framework they would like to adopt and collect information accordingly.
Maybe I can answer quickly to the
Yeah, the double
question
materiality,
related to double materiality. So double
Yeah.
materiality is not obligatory by IFRS S1 and S2 right now. It is becoming a best practice. It is obligatory under different frameworks. For EU Corporate Sustainability Reporting Directive, it is obligatory for those falling under the scope. Then also GRI disclosed communication saying GRI is also supporting the adoption of double materiality process, and there are guidelines around it. It is not under IFRS S1 and S2. IFRS focuses on financial materiality, but what we suggest everyone is to adopt double materiality, add another layer on the financial materiality, put also impact materiality in order to move more efficiently in your enterprise risk management, also sustainability, risk and opportunity management.
Okay.
Yeah,
Thank you, everyone. We have brought down our details. If anyone would like to connect with us, we'll surely be more than happy to connect with you. It was very nice session. If you guys have any other questions, please feel free to email it to us. We'll be more than happy to answer any of their questions.
Thank you very much, everyone.
Thank you.
Thank you
We
so
hope
much,
this session
Manhal,
was useful to all.
Yeah. Thank you so much, Manhal and Ashley, and all of our attendees. So, on behalf of IFA, I want to thank both of our wonderful speakers and all the audience. We hope to see you at our future events. Have a wonderful day, and thank you all once again. Goodbye.
Thank you.
Bye bye.
Bye-bye.
Thank you.